Good evening, ladies and gentlemen. My name is Michalis, and I'm one of the market analysts here at HF Markets, and I'd like to welcome everybody to the first webinar of this week. Now, last week, we looked at a specific type of strategy, but the week before that, we looked at trading plans. Now, what we're going to do today is, now that we've got an understanding of a trading plan and an understanding of a trading strategy, what we're going to look at is how to improve our trading strategy. Sorry, how to improve our trading plan. And of course, if you're improving your trading plan, the idea is to simultaneously improve your trading strategy. So this is what we're going to be looking at as part of today's webinar. Now, for anybody who has been watching webinars over the past couple of weeks, this webinar is going to be a great webinar for you, because it's, in a sense, a continuation of webinars from the past 2 weeks. But the way that I've designed and set up today's webinar is so that even if somebody has never traded before, somebody who's never even thought about investing or previously watched any of our educational videos, then of course this webinar is going to be easy for you to follow as well. Now, a lot of people that have watched previous webinars have heard about me. They know me very well. At the beginning of every webinar, we always do a very quick introduction, which is going to take no more than 2 minutes. The reason why we do an introduction is because I want people to understand that these webinars, it's not just a presentation. You sit, you take notes and watch the presentation, and that is it. But it's actually there and designed, ladies and gentlemen, in order for you to have a session where you can also ask questions. So we're going to be doing polls. We also will be doing surveys. Individuals can ask as many questions as they like. I can already see somebody has asked a question, and I will answer it on the relevant slide. So if anybody has any questions, if it's about something that we're speaking about on a specific slide, or even if it's about something that they personally have found difficult while trading or analyzing, or maybe it's a general question, then of course feel free to ask as many questions as possible. So we want to ensure that this is a great experience for everybody, for us to provide as much information as possible, and to ensure that you leave the webinar with more knowledge and more confidence than you did when you joined. Before we start to look at today's topic, of course, we're going to be looking at the basics of trading plans, and then we will start to look at the simple things that individuals can do to improve their trading plan. And don't forget, the idea of a trading plan is very similar to a business plan. When somebody says trading plan, I want people to think of it as a business plan. And I will expand on this throughout today's webinar. So the end goal is to improve your trading. So to improve your trading plan, improve your trading strategy, improve the money management of your trading as well, and so on and so forth. But before we start to look at that, I want to do a very quick introduction. The only thing I want to say as part of this slide, because we've got a lot of text here, so I want to round it up as much as possible, is of course, when you're trading, you have full control over how you're trading, whether you're going to trade yourself or you're going to copy a strategy provider. And if you're going to trade yourself, it's completely down to you whether you're going to speculate prices are increasing, decreasing, and make sure to, and so on and so forth. So you have full control over your trading. We have no control over how the price is going to move. And of course, because of that, there is a risk to the capital that you are investing, like there is with all investments. It doesn't matter if you're investing in stocks, if it's in FX, if it's in commodities, the same thing applies. But what we want to do, of course, is to provide educational webinars like this, but to also provide as much information as possible and knowledge in order for you to be able to trade and be active in the financial trading markets the way you wish to, but with knowledge, with expertise and with confidence, and know what is required in order for you to potentially achieve the targets that you're looking to aim for. And of course, as part of today's webinar, because it is relevant, we're also going to be looking at what is responsible trading and trading safely, rather than looking at, you know, some dream story. But before we start to move on and away from the introduction, very quickly, this is more for individuals that have never watched a webinar. Most people who have been in the financial trading markets know me very well already. I'm a licensed financial advisor. I've been trading for 10 years now. I was a financial advisor in London for almost 5 years. I've been a market analyst for a further 6 years. I hold 2 licenses actually. I've got one in the UK, I've got one in Europe as well. But the main thing I want people to understand about this slide is I want you to feel comfortable to ask me questions. We've got a lot of experience and a lot of knowledge. It's a massive benefit for individuals like yourself. So feel free now to take the opportunity to ask as many questions as you like. I can see somebody has already asked a question. It's a question which is actually relevant to a slide that I've got here. And of course, I will ensure that that is answered on that specific slide, because it's a shame to answer it now and then to re-look at it again towards the end. So the first thing I want to speak about is the trading mindset. Now, we've got a lot of webinars, ladies and gentlemen, where we look at indicators, where we look at the trading methodology, looking at strategies, ways of entering in and out of the market. But very rarely you hear people speaking about the psychology and emotions of traders, and really sitting down, starting your should we say path in the financial trading markets as a beginner, and ensuring that you're in the right mindset. Very few people actually speak about this. A lot of people are scared to talk about this, whereas I think it's extremely important. So let's go through this point by point so everybody's got a good understanding. Now, as a beginner, and of course I understand we've also got more experienced traders, and there's going to be a lot of things later on in the webinar which are more appropriate to those traders, but this is of course something which is helpful to everybody. As a beginner or a non-experienced trader, you should be potentially looking less at the profits, because a lot of people come into the market and they say, I'm trading, I want to make an X amount of money. The first thing people think about is profit. It's not a bad thing. This is why I'm trading. This is why I'm investing. This is why you're investing. This is why central banks are investing, and everybody else. Nobody's doing it just for fun or just for the sake of it. We're of course here to be earning a specific amount of capital based on our targets. But as a beginner, you're entering into the market, you've never traded before. There's an educational curve to it as well. There's benefits to looking less at the profit, at least at the very beginning, and looking more at the success rate and more at management. So at the very beginning, you may be looking at a very high amount of profit. Most likely you'll be looking at either a break even or a slight loss, okay? But what I want to say to people is, if somebody comes to me and says to me, Michalis, and this happens a lot of the time because we always do one-on-one sessions as well. You guys can of course request one-on-one sessions with me as well. when we're looking at, and when I speak to people, some people say to me, Mihalis, I've been trading for 1 month. I've earned a 500% return on my investment. I'm thinking, wow, that's great. You've been trading 1 month. It's the first time you've ever traded, and you've earned a 500% return. That's more than I earned in my first month in trading. And then I look at their account together and I look at their success rate, and they've actually got a negative success rate. So the success rate is very low, but they, on a specific trade, had a very high amount of profit. And because of that, by the end of the month, they had 500%. It was actually slightly more than 500% return on their investment. And then I've got other individuals. I've got individuals that come to me and say to me, I've been trading for a month. I'm at break even. I haven't earned anything, but I have a very high success rate. So if I've opened 50 trades this month, I've got a 90% success rate. If somebody says to me, if I had a son, which of the two would I rather my son be? To be honest with you, I'd rather him be the second individual who's not earning anything, but he has a high success rate. So that, as a beginner, is more important. So there's benefits, ladies and gentlemen, and you really start to understand this, to, at the beginning, looking less at the profit, and that will also, without you realizing it, actually have a specific domino effect on your emotions and your psychology as a trader. And you will get less sucked into making psychological mistakes while trading. Known as emotional trading. So look less at the profit and look more at the success rate and your management of your account overall. Because if you have a good success rate, and if you have responsible, safe, and a well-managed account, to change that from being at a break-even point to going forward a profitable trader is a lot easier than somebody who has yes, profitable account, but his success rate is poor and the management of his account is poor. The chances are that individual will have a successful month, maybe successful 2 months, maybe successful 3 months, but after that he will start to see inconsistencies. Whereas somebody that has high success, well-managed account and is consistent, he's easily able to convert that into being a consecutively successful trader. And of course, this is what individuals want to achieve. So this is point number 1. We will expand on that throughout today's topic. Do not think of trading as an easy route to become a millionaire, but think of it as a business plan. I will say something else just to add a comment to that. If somebody comes and puts $10 into his account and is aiming to become a millionaire within the year, he is more at risk of being unsuccessful than somebody else who comes and has a more responsible, and should we say, approach to trading. And again, this is something you understand throughout today's webinar. Point number 3, trading will always have profitable trades, and it will also always have losing trades. A lot of people think, I don't want any losing trades. And a lot of individuals, they trade in, and when the trade is in a profit, they close it. And then another trade's in a profit, they close it. And then the trade's in a loss, and they keep it open. They're scared of that losing trade, and they refuse to close that losing trade. What I will say to you today, and people listen to a lot of educators and influencers on YouTube and on Telegram and on WhatsApp, and people say to me a lot of the time, avoid. People tell me avoid losing trades. I'm here to say the exact opposite. Trading, you need to think of it as a business plan, and this is exactly what I'm referring to here. Think of a losing trade as an expense. Okay, think of your trading as well as a business plan. A trading plan is a business plan. Now, when you've got a business plan, especially people who have studied economics like myself, I had modules which were based on accounting. When we're looking at business accounts, there's always the turnover, and then there's always expenses. Every business has expenses. Whether you're selling a product or you're selling a service, there's always an expense. And when you're trading, you should think of it as the same way. You have profitable trades and you have trades that you will close in a loss. Now, because of that, ladies and gentlemen, you have to think of it as turnover and as an expense. It's not an issue to have expenses. All businesses have expenses. The main thing, ladies and gentlemen, is for your turnover to be higher than your expenses. And then as part of today's thing, we're going to look at how you can lower the expenses and increase your turnover in order to improve your trading plan. So like businesses, a lot of the time, especially me as a financial advisor, people used to hire me a lot as a consultant. We look at a company, we look at their services and their products and their accounts, and this is what we look to do. We look to increase income and decrease expenses in order for profit to enlarge as well. This is what individuals need to do in order to improve their trading plan. This is what we're going to look at as part of today as well. Now, point number 4 here is in relation to point number 3 is something that you'll see in point number 2, something you're going to see in point number 3 as well. And I'm just giving an example here. So we've got trader 1, or should we say trader A and trader B. Now, trader A, let's say he's investing and he has a balance of $500. His aim this month or on a monthly basis is to earn $150. Okay, so that's 30% this month, and that's 360% this year. Has anybody heard of an investment which is going to give them a return of 360% within a year? Most years, Bitcoin doesn't even give you a return of 360%, or high volatile, well-performing stocks such as Nvidia. Of course, there is exceptions, and certain years can be exceptions as well. Whereas looking at trader B, we have a balance again of 500, so it's the same scenario, but his aim, ladies and gentlemen, is to aim for $20 a month, which is basically $280 in a year. So that's 4% of the account each month and almost 50% return by the end of the year. Now, somebody came to you and said to you, there's an investment, you put money in, and it gives you a profit and a return of 50%. Somebody who's very experienced within the market will be ecstatic. He'll be so excited. This is definitely something that would interest people. So we need to look at trading this way as well. Yes, trading, you can use trading, and trading can be aimed to provide passive incomes. It can be aimed to as a secondary income as well. So I'm not saying it's not possible. Okay, it 100% is possible. This is why people are trading. But what I'm saying is you need to have a responsible approach in order for you to see good returns. And we're going to look at this as well, and we're going to expand this in a lot more detail. But you can really see here, ladies and gentlemen, how scenario A versus scenario B, which one is likely to be a more responsible trader and be a more happy trader and get better results. Now, people, of course, always mention to me, we're looking at this in order to earn a secondary income. Yes, you can look at it in a more responsible approach like trader B, but is there also other ways to earn secondary incomes as well? Yes, it is. As people become more experienced, and if you're trading now and you're trading for 6 months and then a year and then 18 months and then 2 years, you definitely will become more experienced. And as you become more experienced, of course, you're likely to get better results potentially from trading as well. So people also need to really take education serious, really look at it as a business plan and look to improve their business plan and their trading plan, because what they also can do after, when they become more experienced traders, is become a strategy provider. So a lot of people know that we allow copy trading, so people can share their strategies, in which case people can follow you. Of course, ideally, you want to be a successful, experienced trader in order to do so, which hopefully down the line you will be. And of course, as traders which are following you become profitable, you're of course able to charge them a percentage of the profit that they make. And of course, this becomes an even larger route in order for you to develop potentially a secondary income as well, because you have route number 1, trading. Even if you're only aiming for 4%. This is just an example. Could be 5%, could be 6, could be 7, whatever that may be. And then another route is, of course, being a strategy provider. Last 2 points, and then we'll move on because we're still looking at an introduction, really, and really get into the feel of improving your trading plan. Do not give great importance to when to close. Do not give great importance to when you close a trade in a loss. Now, what do I mean by this? A lot of people really get themselves down and they think to themselves, the trade's in a loss, it was a bad trade, I've lost 5% of my account, I need to earn that back quickly. I'm against the clock, I'm against the market, it's beating me and I need to get back. All right, revenge, let's get money back, let's get back into the positive. And when people do this, they get into that scenario where they get sucked into emotional trading. It's a business plan, okay? Think of it as a business. Anybody that has a business, for example, if we look at one of the most successful businesses in the world, such as BlackRock, such as Microsoft and Alphabet, their expenses is every single day. You may have a losing trade every single day. It's not an issue. And also, when you look at it this way, you will not get sucked into that emotional trade, in which case you're going to make some mistakes. So if there's a losing trade, it's an expense, just like every single business you see every single day. So don't look at it as an issue. Don't give it great importance. We will look at it without emotions, and we're going to explain how you can do this throughout today's webinar as well, especially towards the end when we start to look at statistics and mathematics of trading, start to look at how you can look at trade journals, how you can establish which specific trades needs improving, how to improve them, and so on and so forth. So we're going to look at more advanced levels in about 15 minutes in the second half of the webinar. And in the next slide, we'll look at basic things people can do as well. Last thing, extremely important, and then we'll release today's poll. Do not keep losing trades open unless the trade is manageable. Okay, you don't want to be an unsuccessful trader because you refused to close a trade. I speak to so many people when they say to me, you know, I'm down, I'm making a loss because I opened the trade, the market moved against me, I didn't close it, I don't want to close it because I don't want to finalize that loss, and I'm going to wait for it to move back into my favor. And I always say to them, if you close that trade before it became a larger loss, your trading account will be in a much better scenario. Emotionally, you'll be in a much better scenario as well. Also, who has ever told you that that trade has to move back into your favor? Nobody has ever said that. So just because you're stubborn and you're not looking at this as a business account, you're going to allow that one trade to eat away all of the profit that you have earned over the past 3 months. This is a very similar conversation to somebody that I've spoken to, people that I've spoken to on a lot of occasions. So if you're keeping a trade open, it must be with a reason. So there must be a reason for you to believe, not that it's going to go back in your favor next week or the week after, but that it's imminently going to move back into your favor. And number 2, is that trade, is that loss manageable? Okay, because if it's not, close it earlier so it's not going to cause an issue. Because if you allow it to enlarge, it will be more difficult for you to close that trade. Okay, and this always goes back to point number 1. Stop thinking about profit. You have just entered the market. Think about your success rate. Look to have the highest success rate as possible. When you've achieved that, and we'll show you and look at lots of scenarios on how you can potentially achieve that, then it's very easy to make amendments to your trading account in order for that successful trader, successful analyst to become profitable. Okay, I've got some questions. I've got 3-4 questions. Where can someone download the PDF? We don't provide the PDF for webinars anymore. What we do provide, though, ladies and gentlemen, is the recording. So you will get a recording. You can look at the whole presentation through the recording, but we don't provide the PDF. So poll time, let's very quickly have a poll. I'll only allow 30 seconds for the poll. So let's give me a couple of seconds. So I've just launched the poll. If everybody can answer the poll, I'll only leave the poll open for 30 seconds. So I can see people have started answering. Okay, I can see people only choosing two of the options. Okay, so let's end the poll there. So we have, I've still got people voting actually, but it keeps going up and down, but we have 50% answered opening too many trades and 50% answered they keep losing trades open. To be honest, ladies and gentlemen, it's a mixture of the two, okay? So, you know, some people there's lots of different options here. Some people, yes, find they're experiencing a loss because of news, because of volatility, but a lot of the time, believe it or not, 99% of the time, is because individuals are keeping trades that are losing open for too long, or they keep it open indefinitely and never close it. There's a lot of those scenarios. A lot of the time, people that do that is also people that open too many trades, okay? So let's move on to the next slide. So the first thing I want people to think about, on this slide, we're looking at what should be included as part of your trading plan. The first thing I want people to think about, people always say to me, I want to improve as a trader. I want to improve my success rate. What's the easiest thing that I can do straight away without a lot of education or a lot of thought? What's the easiest thing I can do to ensure that over the next few months, I'm going to become a much better trader? And I always say to people, because a lot of people, a lot of the time, ask very difficult questions like this. More than happy for everybody today also to ask difficult questions, of course. But whenever people ask me questions like this, I always say, only trade one asset. And I would dare people to go onto YouTube and watch Bloomberg Live, because Bloomberg Live have a lot of live analysts come and they interview them. They have traders and investors and they interview them. And you will always find that it will be market analysts or strategists for the Euro USD, market strategists for US stocks, market strategists for oil products. What you will notice is they're specifically analyzing either a specific sector or a single asset, okay? So this is something very important. These are very successful traders. These are very successful institutions like Goldman Sachs and JP Morgan. But when beginners enter the market, they choose to trade 5 different assets, 10 different assets. Some people, I've even spoken to some people, I spoke to somebody actually last week, who almost traded every single asset on our platform. So if you want to become a better trader, okay, especially as a beginner, only trade one asset. It's not that difficult. I don't know why people a lot of the time try and trade a lot of different assets. When you go to study at university, you tend to study one degree, because if you're going to study 3 different degrees, you probably will fail all 3. Whereas if you study one, you have a better possibility and a higher chance of successfully conducting and achieving a degree at the end of those 3 to 4 years. The same thing applies to trading. Trade one asset and ideally trade it in the same session, trading session every single day. So for example, I may choose to trade the Euro USD, which is the cheapest instrument on our platform and on every single platform worldwide, because it's the most traded in the world, is the cheapest, and I may choose to trade it in the US session. But every single day, I would do the same because my knowledge and my expertise and my understanding of that asset is going to vastly improve faster than if I was trading different assets every single day. So trade the same asset, trade only one asset, one session, and don't ever change it. Why? Because your experience and your knowledge will significantly improve. And again, go to YouTube, type in Bloomberg Live, and you'll see it that it's the same scenario with every single central bank, institutional bank and investor. They look at the same scenario. It's not the same as building a portfolio. If you're building a portfolio, you don't want to place all your eggs in one basket. You want to mitigate risk, you want to spread risk, you want to hedge, and so on and so forth. When you're trading, it's not that scenario. You're not building a portfolio. You're entering and exiting, entering and exiting. If you're doing it with one asset in one session, it will be much easier for you because your knowledge and expertise will significantly improve. Now, somebody has asked me a question. Let's quickly answer this question. So I've got two questions, actually. I'll read the first one. So somebody has said, but if I trade one trade, I'll trade less. That's incorrect. Okay, I may trade one trade. I may trade one asset and trade more than somebody else that's trading 5 assets. I might be a scalper, but I'm trading one asset and I'm opening 100 trades a day, even though I'm only trading one asset. So if you're trading one asset, it doesn't mean you trade less or you open less trades or you have to trade lower trade sizes, and it doesn't mean less profit either. Somebody trading one asset can be more profitable than somebody trading 2, 3, 4, 5 or even more assets. Most likely they will be more profitable because they're concentrating only on that one market. Because you have to think about what's influencing the Euro USD is going to be very different to what's influencing Apple stocks or the NASDAQ or the DAX. It's very different. So of course, when you switch assets, your knowledge is zero from the very beginning. So you're starting again as a beginner. Now, ideally, you don't want to start again as a beginner. You want to trade with expertise like professional traders do. So somebody says, when do I take partials off my positions and set break even? Because most of the time, trades hit the break even and run into huge profits. To be honest, this is something that you're going to get a better understanding when we start to look at the mathematics and statistics behind trading. Somebody says, can I not analyze other assets and can I not trade other assets? Guys, your trading is 100% in your control. These are here for educational purposes. They're not here to give you investment advice. If you deem it appropriate to trade more than one asset, you're more than welcome to do so. You have full control over your trading. And to be honest, you may be trading 3, 4 different assets. If you're profitable and you have a good success rate, then why change it? I always say, if it's not broken, don't change it. So that's absolutely fine. But if you're trading multiple assets and you're not profitable and you don't have a great success rate, that means potentially something needs to change, in which case you can take this into consideration. So the next thing that needs to be included as part of your trading approach is, your trading plan, is your trading approach. Are you looking at a short-term strategy? Are you looking at scalping or intraday or day or swing or position trading or news trading? What type of approach? You need to include this as part of your strategy. You need to look at what price movement you're going to look to profit from, and I will confirm what may be most beneficial for you. Excuse me, I'm about to sneeze. I will look at what may be potentially more beneficial for beginners to try and attempt to trade, and I will explain that. So there'll be a trend example on the next slide. As part of your strategy, you need to look at your entry. So how would you determine when you're going to enter the market? How would you determine when you're going to exit the market? we're going to touch base on these very slightly. In regards to these, we have specific webinars where we look at strategies and trading techniques to confirm how to enter and exit the market, but we will touch base on these. But we're going to concentrate more on improving the trading plan side. The size of your trade, so you need to select the size of your trade. Now, if you're a beginner trader, because today's webinar, really, we're looking at beginner traders and how they can improve their trading plan and their trading. I've got here 0.01 lot. Most people will know that 0.01 lot is the smallest size lot. So I'll go back to the very first slide. Stop thinking about profits, because from the very first day and first minute that you enter the market, start to think about your success rate. And then you can start to look at profits. So you've entered the market, you want to start trading, you're taking education, you're looking at webinars, you're maybe taking lessons. Some people may be seeking independent financial advice, whatever it may be. You start off with 0.01 lot, which is the smallest. Probably won't create a lot of volatility on your account. Of course, it depends on your leverage and so on and so forth. And then what you're concentrating on is your success rate. So you're seeing that you've got a good success rate now. Maybe you've got some experience, or maybe you've been trading 3, 4, 5 months, maybe 6 months, maybe more. You're seeing now your success rate has significantly improved. It improved from 50% to maybe 80%, and you're now earning a profit every single week for 4 weeks. So now you can potentially start to look at improving your profit and your profit margin. So what you may do is increase that to 0.02 and then 0.03 and so on and so forth. So this is why I always say it's important. Start to look at the success rate, and then you can start to look at the profits. Market exposure. So you need to look at how much you're exposing yourself to the market. Ensure you're not opening too many trades. You're not opening too many trades at the same time, that you're not running and chasing after losses. Which I really spoke about at the very beginning, avoiding emotional trading. If you're closing your losses at the appropriate time, we will look at that in a couple of slides as well. You're going to get a really good understanding of avoiding emotional trading and keeping your margin level, or the margin that you're using compared to equity, at the appropriate level. So you want to ensure the trades that you're opening, that they're not damaging or overexposing your account. Again, we're going to be looking at this in more details, looking at real examples towards the second half of the webinar as well. Let's very quickly have our second poll of the day. Okay, ladies and gentlemen, so you have now only 30 seconds. Let's quickly answer this poll. So how long are you typically keeping trades open for? So if you're leaving maybe 10% open for longer or shorter, it's absolutely fine. You don't have to necessarily answer something else. It's just typically how long are you leaving your trades open for? All right, so we've left it open now for 30 seconds. So we have 92% say less than 24 hours, sorry, 93%, and 7% say 1 to 3 trades. So everybody really is, well, most people are ultra short-term and short-term traders, probably maybe a lot of scalpers, which is absolutely fine. We look at that quite a lot. We actually had a couple of webinars looking at scalping strategies last week and the week before that. And then we had some individuals potentially looking at swing trading. There's no right answer, so it's a poll. It's not a questionnaire, it's a poll. So what did I say in the previous slide that we look at? I confirmed and I promised everybody that I said your trading approach and looking at what you should be potentially trading. To give you an example, most financial advisors and most professional traders advise, and people can do their own research in regards to this and look at surveys like I have done, that when traders that are beginners are trading in favor of the trend, their analysis and their trading is easier. So people always get sucked into trading in both directions of the market, because they may say, you know, 2 days it's moving in favor of the trend, today it's moving against the trend. I don't want to hold back for a day and not trade for a day, so they just keep on trading non-stop. Whereas if you're only trading in the direction of the trend, there is a lot of benefits to this. Okay, doesn't mean that you cannot take maybe shorter term trades against the trend if you really do honestly believe that it's 100% going to be a specific profitable trade, but focusing on the direction of the trend. So here we got the Dow Jones. This is an example from the past few days. Very clearly we can see it's a downward trend. Here you can see I'm measuring each price movement, each impulse wave, that's how it's known, in favor of the trend. So this is in favor of the trend, this is in favor of the trend, this is in favor of the trend, and this is in favor of the trend as well. And I'm also measuring price movements against the trend. Now, if I add all this up, the price and volatility in favor of the trend is just over 5%, so 5.27%. And against the trend, so the correcting is 2.85. So in favor of the trend, more than 5%. Against the trend, less than 3%. So you can see there's a very big difference there. Now, if somebody's rolling a dice, and there's 2 numbers on the dice, there's 6 sides. On 4 of the sides, there's the number 1, and on 2 of the sides, there's the number 2. Okay, like this scenario here. And I roll the dice, and people are going to start betting, even though investments aren't betting, but I want people to see this example in the clearest and simplest way. You're of course going to choose to speculate that it's going to fall on the number 1. Why? Because most of the time that is the scenario. So this is why there's benefits to trading in favor of the trend and not against the trend. Don't want to spend too much time on that slide because there's more important things to look at as well. But again, you can really see there, ladies and gentlemen, that there is benefits to focusing your trading in favor of the trend. So orders. Let's get a good understanding of orders, ladies and gentlemen, and then we're going to start to look at improving our trade success rate and looking at the mathematics and statistics behind trading and how to improve that. Probably the most important slides of today's webinars will be that. But let's look at orders and how you can use orders to improve your trading, especially for beginners and people that have never traded before. So the first thing, everybody knows that there's buy trades and there's sell trades. So there's trades where you're entering the market and speculating the price is going to increase and speculating the price is going to decrease. But what are other orders that you can take into consideration? The first one we want to look at is a take profit. So, and this is basically an order which is you're going to preset a target. Okay, so maybe there's volatility, you're looking to trade and speculate an increase at let's say $90. You're saying that, predetermining that at $95, you will close, the system will close the trade automatically and cash in and confirm and secure that profit. Okay, so this is what a take profit is. It's an order to automatically close the trade at a certain price to lock in the trader's profits. So for example, we may have some volatility like this. I may open a buy here and I'm saying to the system, if the price increases to here, close the trade. So as soon as it goes up to here, it will automatically close the trade, but I'm on the computer or not. So I've got somebody here. Why doesn't HFM allow for multiple take profits when placing an order? What I will say, ladies and gentlemen, is it's a better option will be, instead of opening, for example, 1 lot, you can open 10 trades at 0.010 lots, each of them with a different take profit. So if you want multiple take profits and multiple stop losses, and you want to scale in and scale out, this is how it's known within the market. This is the best option. You're not charged more for doing so. So that's the best options. Instead of opening one large trade, open multiple smaller trades which equal the same amount with different stop losses and different take profits. So hopefully that answers that question. If you want to explore it more, it's known as scaling in and scaling out of trades. So ladies and gentlemen, next order is a stop loss. So the stop loss is an order to automatically close a trade at a pre-chosen price to avoid a larger loss. This is extremely important. Now, even if somebody doesn't want to have a stop loss and take profit, some people prefer people not to be able to see where they're placing their targets and their risk levels. That's absolutely fine, because of course people can see that on the depth of market, and if people don't want people to see it, of course it's not so much relevant for derivatives, but for the trading a real asset, you can see it on the depth of market. But either way, if people don't want people to see the take profit and stop loss, at least mentally have a stop loss and take profit. Okay, so the same thing basically applies. So this is stop loss. It's exact same as a take profit, but it's when the market moves against you. Then you've got a trailing stop. So what is the difference between a stop loss and a trailing stop? A stop loss, ladies and gentlemen, is, again, let's say, for example, I'm buying here at $90, okay, and I'm putting a stop loss $10 below. So my stop loss is here at $80. If the price declines down to here, it will close the trade and I've lost $10, okay, as I set the system to do accordingly. What is a stop, this is a stop loss. What is a trailing stop? A trailing stop, ladies and gentlemen, is basically a stop loss is static. It will never move. So for example, if we're looking at a scenario like this, let's say I'm buying here, I'm placing a stop loss here. So this is my stop loss. If the price increases up to here, my stop loss will still stay here. It will not move. It will stay static. A trailing stop is, maybe again I'm saying, excuse me. So a trailing stop is basically when you're setting a point in the market, it's still, should we say, $10 below the current price, where you're open the trade, but it's not static. So let's say, for example, you open the trade at $90, you're placing the stop loss $10 below. So here, for example, you've got $10, so $10 trailing stop. So it's at $80. And let's say you're currently now at $150. What happens is your stop loss, which is actually a trailing stop, will continue to move up as well. And the trailing stop will go to $140, so $10 below. So what actually happens now is if the price declines, it will close the trade at 140. So it's not only protecting you against a loss, it's also protecting your profit that you have earned as well. So there's advantages and disadvantages to it still, as there is with stop loss, because sometimes volatility may knock out the trade. But nonetheless, you've got to take profit and you've got a trailing stop. Now, what do a lot of people use a trailing stop for? Because a lot of the time they don't want volatility to hit the trade and knock it out. But what they may do is, for example, if they've got a trade, for example, I may open a buy here, the price moves up, it moves into my favor. For today, I'm plus $50, for example, but I have to take profit at $60, and I don't want to risk the price declining and then me closing the trade at a loss. I want to secure either a break even or a certain level of profit. So what they'll do is they'll place a trailing stop at the break even, so that trade cannot go into a loss, or they may have a trading stop slightly higher, so there's a small profit at least. So this is an option for trading stops. Somebody says if I can watch the recording because I have to leave. Yes, of course, the recording will be sent to you, ladies and gentlemen. Last thing, pending orders. A pending order, when you click buy and sell, it's a market order, which basically means you instantly enter into the market at the best available price. When you're looking at pending orders, when you're looking at pending orders, you are not instantly entering the market, but you are waiting for a certain price, and you're saying to the platform, when the price goes to this level, open this trade. So for example, maybe because of news, for example, or maybe because there's been a lot of volatility and people stop buying, it loses momentum. Somebody may say the price is overbought and they want to speculate decline, but they don't want to trade just yet. They want to wait for some momentum before trading. So maybe we've got a high price like this, it loses momentum, starts to move sideways like this, and somebody will put a pending order here. Okay, so a pending order. So basically what it's saying is if the price declines like this, that there's this much momentum, here it will open a trade to speculate a decline. This is a pending order. So in regards to pending orders, there's two types. There's stop orders, which are basically when you're going to trade in favor of the trend. And then there's limit orders when you're going to trade the change of trend. I've got some questions here as well, so let's quickly answer these. Does the trailing stop move on its own in order to save existing profits? Yes, it still works as a stop loss. So if the trade never moves in your favor and just straight away moves against you, it works the exact same way as a stop loss, and will close the trade to avoid larger losses. But if you, let's say for a couple of days, have kept the trade open, or a couple of hours, it's in a profit, it's plus 50, plus 100, plus 1,000, whatever it may be, you can place a trailing stop to protect a certain percentage of that profits if you haven't already done so. Now, pending orders, there's stop orders which are trading in favor of the trend. So for example, as the price increases here, but you believe maybe it's going to decline, you may say, as soon as it breaks below this level, this is the breakout level, so we've broken below the support or the significant price level or the psychological price level, whatever you're choosing, is absolutely fine. But you're setting this level for a pending order, and more specifically a stop order. So if the price declines to here, it will open a trade to speculate the decline. As it's declining, somebody may say, if it hits this price, if it goes to this low, then I believe that it will retrace. So here, if it decreases to here, you may place a limit order, which will automatically trade the change in the trend. So for example, here you can see I could have chosen that level to speculate the price increase. Higher risk here. Why? Because we're trading against the trend. So my timing is very important there because there's a smaller price movement and there's a price movement against the trend. Whereas even if, for example, I was trading downwards, but I was trading downwards here, my entry's poor, my timing's poor, my analysis is poor as well. But overall, I'm trading in the right direction. So my trade and my mistake is more forgiven because if I keep the trade open, eventually the price is going to move against me very, very soon. And also there's limited volatility against me as well. Why? Because I'm trading in favor of the trend. Whereas if I speculate, let's say that the price is going to increase here. So here I'm speculating the price is going to increase. It's not forgiven. There is in no way or in any scenario where based on this chart, that you can see the price moves against me, that is going to hit a break even or a take profit. It's just not going to do so. So you can see here exactly why I'm referring to the benefits of trading in favor of the trend rather than benefits of trading against the trend, which has more risk and more limitations. So trading the entry and using orders. So for example, a lot of people may say, you know, I'm trading the downward trend. So for example, here, let's say, I may say, you know, I'm trading the downward trend. This downward trend has happened, but let's say this here hasn't yet happened, for example. Let's say this hasn't happened just yet. But let's say, you know, I can see some downward price movement and I want to trade the downward trend, but I want to wait for the retracement first. The retracement starts to form. I've drawn my Fibonacci based on this high and this low, like we did last week on the strategy that we were looking at. And basically, we want to trade at this orange line. As soon as the price starts to move in favor of the trend, that's enough momentum for us to basically start to speculate that the trend will continue and the price will continue to decline. But that hasn't happened yet. Unless I can't stay on the computer, I don't want to miss that entry. So as the price is increasing in value, I may place a pending order that if the price decreases, to automatically open a trade to speculate the decline here. So you can see I'm speculating a decline here, and I put a take profit here, and I put my stop loss slightly higher than the previous high. So you can see exactly what I'm looking at here. And you can also see the distance between my stop loss and my trade and my take profit is that I've got a higher reward to risk ratio. So I'm looking to earn more than what I'm looking to risk as well, which, you know, somebody can have a negative reward to risk ratio and still be successful. We're going to look at that, but there is benefits to having a positive reward to risk ratio as well. So here, ladies and gentlemen, you can see how I'm looking to use a pending order. Now, this, ladies and gentlemen, is probably the most important slide, this onwards, because this is where you're going to see how to improve your trading plan. So here we're looking at the statistics and mathematics of your trading. We've got 3 examples. Let's go through these actually. We'll read through it. The ability to identify the market's next movement is not the most important aspect of trading. The most important aspect of trading is the trading plan. This here is a trading plan. So you're looking at your success rate and saying, based on this success rate and this trade size, and these amounts of trades that I'm going to open and have been opening, this is the reward to risk ratio which I need in order to still be profitable. So what do I mean by your success and your ability to determine the next price movement isn't the most important? Because even somebody which has a poor success rate can still be profitable. So we're going to look at 3 examples. People are really going to get a good understanding when we look at these 3 examples. So let's look at, for example, John here. John opens 30 trades a week. You can see Jude opens 30 trades a week. Mary opens 30 trades a week as well. What's the difference though? John has a 67% success rate. Jude has a 90% success rate. And Mary has a 35% success rate. So 3 very different traders. Let's say, for example, Mary is a beginner trader because she's new, and because of that, she has a low success rate. But what you notice is scenario A is earning a profit. Jude is also earning a profit, and Mary is also earning a profit. So regardless of their success rate, they're earning a profit because they're setting their trading plan in accordance to their trading characteristics and the mathematics, the statistics of their trading, which doesn't lie. So let's look at John. John is looking to earn $40 per trade, and per trade he's risking $20. So he has a reward to risk ratio of 2 to 1. Okay. He has a 67% success rate, so every single week he records his trades in a loss, in a profit, and he knows his success rate. So based on his success rate, 67%, he has, because he opens 30 trades a week, he has 20 trades he closes in a profit, 10 trades he closes in a loss. So based on 40 and 20, he has basically a turnover of 800. So if we do 40 times 20 is 800. If we do 20 times 10, the expense is 200. So losing trades are 200. So his profit is 600, ladies and gentlemen. All right. But you can see here, he needs to look at his success rate, how many trades he's opening, his success rate, what that means in terms of how many trades he'll close in a loss, how many he'll close in a profit, and he knows where he needs to place his reward to risk ratio. So here's how much he's looking to earn and how much he's looking to risk per trade. Okay, we're gonna look at this in more and more detail, so please bear with me. Let's look at Jude. Jude is the exact opposite. He has a negative reward to risk ratio. So per trade, he's risking a lot. He's risking $50, and he's looking to earn 5 times less. So he has a negative reward to risk ratio, a reward to risk ratio of 1 to 5. But because he's given the market more space, time, he has a high success rate. It's absolutely fine. What you don't want is a negative reward to risk ratio and a low success rate or an average success rate, in which case there's no point. But we're going to look at how to improve this on the next slides. But you can see this basically means 27 trades in a profit, 3 trades in a loss. He's looking to earn 10 and he's risking 50. So 10 times 27, turnover of 270, 3 times 50, 150. So he's got a profit of 120. Okay, then we look at Mary, still 30 trades per week. She's a beginner, she has a very low success rate, 35%, but she has a high reward to risk ratio because she knows, because she's got a low success rate, because most of the time she's unable to determine how the market is going to move. She knows she needs a high reward to risk ratio. So she's looking to earn 32 per trades and she's risking per trade 8. She has 11 trades in a profit and 19 trades, 11 trades in a profit and 19 trades in a loss. So if we do 32 times 11, 363, I think that's slightly incorrect actually, but either way, it's more or less there. And then 8 times 19, 152, okay? Profits, 150 at 2, which is also incorrect as well. Anyway, though, she is profitable because she is setting her take profit and her stop loss, or she's looking to risk and earn in accordance to her success rate. Okay, this is what and you need to do in order to improve as a trader and improve your trading plan. So let's look at another example. We've got Timmy Topper here, 30 trades per week. He's got a reward to risk ratio of 2.5 to 1. So he's looking to earn 25. He's risking 10. He's got a success rate of 37. So he's basically, from his 30 trades, he's opening and closing 11 trades in a profit, 19 trades in a loss. Based on 25, he's earning turnover, profitable trades of 275, and he's earning a loss on the 19 trades, which add up to 190. So his profit, ladies and gentlemen, is 85. So yes, he wants to improve his trading plan. He's going to look at if he's incurring overnight fees. He's going to look at what price conditions there are when he's trading. If he checks the price condition, if he looks at multiple time frames, like we looked at in strategy last week, we looked at the 2-hour and then the 5-minute time frame. What indications is he looking at? Are they given accurate indications? Does it need to change the period? If they're not, these are things that, of course, he's going to look at in order to improve his trading plan. But what else can he look at? This is the main thing. Does increasing the risk increase his success rate? Because you can see here, ladies and gentlemen, his success rate is 37%. So if he increases his success rate, if he increases his risk, does he increase his success rate? And how does this influence his weekly profits. So let's say he's opening a trade here, his take profit is down here, and his stop loss is this red line here. So if he increased his risk, so if he put his stop loss up here, the trade wouldn't have closed in a loss. Actually, the market, yes, would have moved against him at first, but then started to move in his favor, and he would have closed it in a profit. So if he increased his risk, he would also increase his success rate. So based on that, what does he need to look at? He looks at all of his trades. So the 30 trades he's opened this week, and he looks at if he increased his risk, what would be his success rate? And he would redo this calculation. So based on the new reward to risk ratio, so let's say, for example, if it's still 25 trades, $25 he's looking to earn per trade, but his loss now, let's say, is 15, okay, that he's looking to risk. It may be slightly different, maybe 17, maybe 18, it's just an example. But if he increases it, what is his success rate? Okay, so how many trades are in a profit, how many trades are in a loss? And he will redo this calculation here based on that, and he will know based on that if he improves his trading plan or not. Okay, so it's all about the mathematics behind the trading. Let's look at another example here. This time somebody is a successful trader, slightly, should we say, it's not very successful actually. He's got a success rate of 60%, but based on the previous slide, a much better trader. 60%, he's looking to, 60% of each trades he closes in a profit, 40 he closes in a loss. But his profit is very low because he has a reward to risk ratio of 1-to-1, so he's looking to earn $10 and he's risking $10. He's opening 10 trades a week, so his profit, 20 trades a week, so his profit is $40. He wants to, yes, improve his success rate because it's still lower than he would like it to be. So he will refer to the previous slide, look at all his trades, see if he can lower his risk, but at the same time, let's see if he can increase his profit as well. So he will look at his trades again, so the trade journal. So let's say again, he's looking to open a trade here. He's got his stop loss here, ladies and gentlemen. So this is his stop loss. This is where he's opening the trade. Never goes anywhere near his stop loss because it instantly starts to move in favor of the trade. He's speculating a decline, and he closes the trade here. So what is he looking to do here? If on every single scenario that he closes in a loss, closes in a profit, here you can see he could have actually kept open the trades longer. So instead of closing it here, why not close it here? In which case, maybe his reward to risk ratio is now, the risk is $10 and his take profit is $20, or it could be $10 and $15. So he needs to look at that. If on every single scenario that his analysis was correct, he could have put the take profit further away. He knows he's able to do so, and it improves his profit. But if he looks at it and he says, out of the 20 trades, out of the 12 trades that were in a profit, on 2 occasions I could have put the stop loss, the take profit further away, but on 10 occasions I couldn't. I would have actually not hit my take profit and then go to a break even or loss. Then he knows he cannot take his take profit further away. Otherwise, he could have. Okay, so he knows he can do that to improve his trading plan. So you can see we've looked at, ladies and gentlemen, how he can do so to improve profit, potentially also improve his success rate, and potentially also improve the management of his trade and his accounts as well. Lastly, what can we look at in order to improve our trading? We can use more time frames. We looked at that last week. So this is something people can really look at. Are you looking at the appropriate time frames? Are you using multiple time frames? A lot of the time I say to people, try and use a longer term, a medium term, and a short term time frame. So for example, a 4-hour, a 2-hour, and a 5-minute. Okay. This is just an example as well. Some people a lot of the time look at a 2-hour, 30 minutes, and a 5-minute. It's completely down to you. You can explore different options. We looked at a lot of options actually in March, where we looked at a lot of strategies. All of these are also available on YouTube as well. Try and use longer time frames to confirm the price condition. Trade the second impulse wave rather than the first. For example, here you can see the first attempt to increase. We avoid that because it's higher risk. Indeed, we saw on that occasion it increased. Also, if it's the first impulse wave, so the first attempt, a lot of the time you're at risk of a false impulse wave, also a false breakout. So because of that, you want to avoid it because it can lower your success rate and put you in a difficult position. Rather than do that, you can trade the second or the continuation of the trend rather than the first attempt to form a trend. So we can look at that. We can look at trading the breakout. Either if we're not going to trade the breakout, trade at the 60 mark on the Fibonacci or the 61 some people use. Some people also use the 64. Either way is appropriate. Use pending orders as well. Trade journal, trade the sentiment. So what we looked at on the very first slide, trading one asset, looking less at profit, more at success rate. But also trade journal. Look at your trade journal, look at the statistics and the mathematics behind your trade. Because even if you're an unsuccessful trader, you can tweak your trading plan to at least make you profitable. Or even if you're a profitable trader, sorry, a successful trader, but not profitable, again, you can tweak your trading plan in order to ensure you are profitable. So ladies and gentlemen, that brings us to the end of today's webinar. If anybody has any questions, feel free to ask now. We'll leave the webinar open for a couple more minutes. We've been speaking for an hour and 10 minutes, so it's lasted longer than we would have liked. How many trades would you advise a beginner trader takes a day? Number one, we don't advise, okay? But for educational purposes, what I will say is the most important thing is if you're a beginner, you've never traded or you've got limited experience, try and trade where there's not conflicting signals, fewer trades, and the smallest trade size, so 0.01. Okay, set yourself a strategy. Let's say you've got a strategy that you've tested and you're happy with. Start to use it on, for example, 5 trades a week on 0.01. Was a successful week? Next week, do the same. As you're trading, your experience and your knowledge will become better and more advanced as well. Then you can tweak it. Don't be in a rush. After that, you can increase it to 7 trades, to 10 trades. Also, you can tweak the trade size, and so on and so forth. So it's not, a magic number. It's about starting slow, starting small, and looking not at the money, but the mathematics of your trade. So the success rate, the number of trades, if you're profitable, the reward to risk ratio, the success rate, and how you're going to tweak it to improve it when you're looking at past trades. So looking at a trade journal, looking at the examples that we looked at. If I put my stop loss further away, does it improve my trading? If I put it closer, does it improve my trading? Same for the trailing stop or trailing stop or the take profit as well. So that's the main thing. Please kindly show the previous slide. Yes. But keep in mind, you can still ask questions, guys. So we're not on the slide now where we are stating that you can ask questions. This is the previous slide, but feel free to ask as many questions as you like. So I will leave the webinar open just for 1 more minute, and then we'll end it there. Can actually see most people are leaving the webinar, so most likely people don't have questions. Let's just wait a couple more seconds. Otherwise, we will end it there. So let's end it there, ladies and gentlemen. Trade safe, trade responsibly. Hopefully you found today's webinar educational and informative. In the meantime, hopefully we'll see you very soon on our next webinar. Goodbye.